So guys, on the board behind me, I hope a few of you are now happy because we're answering your questions on what is gap funding. This has been asked a number of times about, I was at an REI club or a seminar and the speaker was talking about funding the gap or talking about gap funding. I didn't know what they were talking about. We're gonna break this down so you can understand this because this is crucial if you're a rehabber to understand that your ability to do a lot of properties is limited upon your ability to fund the gap because lenders are not gonna fund every dollar of every deal unless you're finding really good deals and have the right lenders. So let's look at what gap funding is and we'll kind of talk about this as the video goes through. This is you a house flipper at top. This is the house you wanna buy. The sales price for this house is $100,000. This is what you worked out with the homeowner. They agreed to sell it to you for $100,000. You've run all your numbers and you think the house is worth $250,000 fixed up, or what is called your ARV, your after repair value. This is the market value of the property after you fix it up to the level of condition that you're gonna fix it up to. So you think you're gonna put in $50,000 and it's gonna be worth $250,000 when you're done. Okay, so here's your total cost in the project. $100,000 to buy it, $50,000 in repair costs. Now obviously there's no way to know what your repair costs are until you get done with the project because it's gonna vary. We only play with the ranges on the front end. We try to get as close as possible, but it's never gonna be accurate, right? Then you're gonna have closing and carrying costs. This is your front end closing costs, your back end closing costs when you sell it, your carrying costs, your water, your taxes, your electric, your insurance, your loan fees, your taxes, everything combined, guys, we're gonna use in this example. We're not gonna break it down. So 100 to buy it, 50 for repair costs, and 50 for your carrying and closing costs, leaving a total cost for the project, $200,000 total. Let's assume you're great at running your numbers and you sold it for $250,000, which you thought you could. So your total back-end sales price right here is $250,000. Your total cost, remember, is $200,000, leaving a $50,000 profit. Now you can't get to that $50,000 profit unless you can finish the deal. And in this example, there's gonna be a gap. The lender's not gonna fund the whole thing. So how do we look at this right here? So this is a lender down here, guys. They're gonna fund usually 70% loan to value. Some will lend a little bit more if you find a good lender, but most lenders out there are only wanting to fund about 70% loan to value of the future value of the property, or the ARV. So in this case study, their ARV times 0.7 because they want to position a leverage position in case they take the property back, that they have room in it to sell it and not lose money. So they're gonna get paid by you interest, and if the deal goes through, they get paid. If the deal doesn't go through, they take it back from you with a position of leverage of equity, and they fix it up and sell it because a lot of lenders were rehabbers at one point. So they're gonna win either way, right? So let's say the ARV is $250,000, their loan amount is 70% of loan to value, or 70% of this ARV, or $175,000 total. That lender's only gonna give you $175,000. But remember, your total cost is $200,000. So total cost $200,000, total loan amount $175,000. To complete this deal, you're gonna need $25,000 out of pocket, or through credit cards, or through a credit line, or through a gap funder, or someone to fund the gap, because that $25,000, the difference between your total cost of the project and the total amount the lender is gonna give you is your gap. Now this is important because this is how rehabbers get in trouble and go broke. They didn't plan or run their numbers correctly, and they only had $25,000 to budget for this property for the gap. Then they had unexpected surprises. The project went longer, more repairs. They can't finish the project because they're behind on, say, 2 or 3 at a time. Then they get foreclosed on all of them, right? So it's very important to understand you need to be prepared to cover the gap and leave a margin of error, because this is how a lot of people went out of business in the last recession. They built a successful rehabbing business over 5 to 7 years, made a couple $1 million, then they took on a bunch of big price point properties, 500 to 800K properties, where their gap funding may be $100,000 to $200,000 out of pocket. Then the market turned abruptly in a 6-month time period. All those houses' values dropped by 30 to 40%. Now even to finish it, they're gonna lose more money, and a lot of them just get caught top of market, and that's how a lot of them get pushed out of the business, right? So your gap is important to understand because this is a limitation of how many deals you can do. If your average deal is XXX as far as the gap funding, let's say you're averaging $25,000 per gap on each property. If you have $100,000, you can only do 4. If you have $200,000, you can do 8. So most people, like I said, are using credit lines, credit cards, or their own cash to do this. So this is what the gap is, guys. If you have other questions, just email us and I'll go down another video even a little bit further. But I hope this answered your questions. If you haven't already done so, subscribe to the channel if you thought this was helpful. If not, comment below, and I'll see you on the next one here in a few days, guys. Have a good day.